We now want to talk about estimating the actual cash flows that a project generates. Note that this is a different number than the accounting income, which takes into account non-cash expenses like depreciation. To determine the annual cash flow of a project, we begin with sales and then subtract any operating costs. Since we have to figure out our tax expense, we then subtract depreciation expense because we don't pay taxes on our depreciation expense. This gives us EBIT, earnings before interest and taxes. At this point, if we were on our income statement, we'd normally subtract interest, which would give us earnings before taxes. However, since we're trying to estimate the cash flows of the project in each year, any interest will be taken care of later when we discount these cash flows. If we were to subtract interest now and then discount the cash flows, we'd be counting interest twice. So at this point, we take taxes directly out of EBIT, and this leaves us with NOPAT, our operating income. Since we're looking for the actual cash the project will generate each year, we want to add back in our depreciation expense to our NOPAT, since it's a non-cash expense. This value will give us our expected annual operating cash flow. So let's look at an example. Suppose a project is expected to generate $500,000 in sales every year, and operating costs are forecasted at 60% of sales. The project's annual depreciation expense is $50,000, and additional annual interest expense because of the project is $40,000. So maybe we're assuming that the firm raised some new debt and now has additional interest expense because of this new debt. If the firm's tax rate is 35%, what is the project's expected annual operating cash flow? Well, first we want to start with sales. We had $500,000 in sales revenue from this project each year. Our costs are 60% of sales, so 60% of $500,000 gives us costs of $300,000. And we subtract depreciation of $50,000. That gives us EBIT of $150,000. Now we want to take taxes directly out of EBIT. 35% of our EBIT equals $52,500, so we subtract that. We're left with NOPAT, our operating income. That's $97,500. Now we add back in depreciation because it's a non-cash expense. We're looking for the cash that this project generates. If we were to leave depreciation out of it, that would inaccurately report the cash that's generated because, again, depreciation is just, we use that to match our revenues and our expenses. We're not actually paying $50,000 for the depreciation. It's a non-cash expense. So we add that back in. Once we add that back in, we get our operating cash flow of $147,500. Now, to estimate the expected operating cash flow in the final or terminal year of the project, we need to consider some additional items. Typically, we need to increase our current assets at the beginning of a project. Recall that some liabilities also increase whenever we have a growth in sales. If we reach the end of a project and the increase in our current assets was greater than the increase in our liabilities, we may have some assets left over that we can sell. In this case, we can sell these assets, for example, any excess inventories that we have left over from the beginning of the project to the end, and we can recuperate some of the initial investment in this operating working capital. That's what we call things like current assets, like cash, any cash, or investments or inventories that we had. So this amount will be added to our cash flow for the final year of the project. Basically, it's the end of the project, and we're going to get back anything that we have that's still a value that we can sell that is not going to be used anymore since the project is terminating. So that's going to actually be part of the cash flow for this terminal year of the project. Additionally, we may actually sell some of the fixed assets that we purchased at the beginning of the project. So these aren't things like inventories, these are actually things like these fixed assets, plants or equipment that we purchased. If the price that we sell these fixed assets for, called the salvage or market value, exceeds their balance on our accounting books, called the book value, we will have some additional income from the sale. So the book value is what the equipment is worth after all the depreciation expense that we've taken out over the years of the project. If what's left is lower than what we can sell it for, we treat this difference as income for the project. So since this is income, we have to pay taxes on it, just like we pay taxes on all of our other income. The cash that's left will also be added to our cash flow. So let's look at an example of finding the operating cash flow for the terminal year of a project. Suppose we want to find the expected operating cash flow during the terminal year of a project. When we undertook the project, we increased our current assets by $10,000. Simultaneously, our current liabilities were increased by $3,000. Assume that all net operating working capital is fully recoverable at the end of the project. The salvage value of a piece of equipment that we bought will be $180,000 and its book value will be $100,000. If the tax rate is 35%, what cash will the recovery of net operating capital and the sale of equipment generate? So here in this example, we're just looking at what we're going to get back from the recovery of our net operating working capital and the sale of our equipment. We're excluding the normal revenue that our project would generate, like what we found in the first example. So if we wanted to find the total amount of cash in the last year, we would have to include any normal cash that the project was generating just based off sales. So first, let's find the value of the operating capital we'll be able to recover. The change in current assets minus the change in spontaneous liabilities, that's what we'll be able to recover. Remember, if we initially invested in a bunch of, say, inventory to sell, and at the same time we had notes payable, a spontaneous liability that increased, if we had a greater increase in inventories than we had in notes payable, the difference is what we're going to recover. So that's why we're subtracting spontaneous liabilities, the change in spontaneous liabilities from the change in current assets. The difference, again, is what we're going to recover as of the terminal year of the project. Well, the change in current assets was $10,000. Our liabilities only went up $3,000, so what's left over, the $7,000, we'll be able to recover that. So that's the cash that's coming in from the recovery of net operating working capital, the $7,000. We'll also be selling a piece of equipment for $180,000, and this equipment, we're told, has a book value of $100,000. Thus, our income from the sale is just the difference, $80,000. We have to report this as an income of $80,000 from the sale. Well, taxes are 35%, so we owe 35% of the $80,000 in our tax liability. That's $28,000. So the total cash from these two activities is the $7,000 from the recovery of net operating working capital plus the $80,000 of income from the sale of the equipment minus the tax that we owe on that income of $28,000. That gives us cash from these two activities equal to $59,000. And that's the end of part 2.